Warren Buffett spent decades building his empire on a strict philosophy: stick to what you know. For him, that meant avoiding the technology sector entirely, favoring businesses with predictable, traditional cash flows over speculative code. This chart shows Berkshire Hathaway's portfolio today. Notice the massive new addition right near the top. Berkshire has quietly accumulated a $31 billion position in Alphabet, Google's parent company, making it their seventh largest holding. Naturally, Wall Street assumed this was the work of Greg Abel. Buffett recently passed the day-to-day CEO duties to Abel, and a heavy pivot into modern AI infrastructure seemed exactly like a younger executive eager to make his mark. But in a recent interview, Buffett set the record straight. He evaluated the tech giant, bypassed his historical aversion to Silicon Valley, and pulled the trigger himself. Why is the ultimate tech-averse investor suddenly throwing tens of billions of dollars at a search engine in the middle of a massive cash-burning industry war? Buffett is completely ignoring the artificial intelligence hype. He's applying a strict rule heavily championed by his late partner, Charlie Munger. Ignore the trendy narratives and look purely at a company's ability to earn and distribute real cash. That brings us to return on invested capital, or ROIC. This metric simply measures how efficiently a business turns every dollar it reinvests into its operations back into pure profit. Look at this line chart tracking Google's ROIC. Back in 2017, they were already posting a healthy 16%. Today, that number has climbed to 31.6%, completely towering over the typical market average of around 15%. Buffett values Google as an incredibly efficient machine that generates massive returns on every dollar spent. This efficiency secures its status as a long-term compounder. While newer, speculative competitors like OpenAI projected a $25 billion revenue run rate, they are also committing to spend an astronomical $600 billion over the next few years. Competing in the current tech environment requires building out physical infrastructure on a terrifying scale. It's an arms race where hyperscalers are forced to commit hundreds of billions of dollars in capital expenditure just to stay in the game, money many of them don't actually have. This bar chart compares Google's spending to its cash flow. While Google expects to spend up to $190 billion in capital expenditures by 2026, they generated over $400 billion in revenue and kept $132 billion in pure profit last year alone. They fund their own future effortlessly. Because the business has been highly profitable for so long, Google possesses a massive financial moat. They can afford to play a multi-hundred billion dollar long game that Buffett notes 95% of other companies simply cannot enter. For Buffett, Google's ability to gush cash while comfortably footing the bill for massive technological expansion makes it a proven winner, independent of who dominates the daily tech headlines. All of this internal cash generation results in a balance sheet so fortified it acts as a permanent safety net. This visual scale demonstrates their financial leverage. As of the first quarter, Google held $127 billion in cash and treasuries, projected out to produce $73 billion in free cash flow, against only $77 billion in long-term debt. This makes Google a financial fortress, generating wealth so reliably that it rivals the most successful industrial businesses in history. But despite these staggering numbers, Buffett dropped one final twist in his interview. He admitted he actually likes at least 4 or 5 of Berkshire's other businesses more than he likes Google. The $31 billion position represents a cold, calculated judgment of opportunity cost, rather than a conviction in specific AI technology. Buffett views investing through the lens of history's great long-term compounders, figures like John D. Rockefeller, who built massive wealth by relentlessly compounding oil and gas returns over decades. It's incredibly difficult to maintain high growth rates at a massive scale. Yet Google is doing exactly that as a multi-trillion-dollar company. He weighs this compounding machine directly against his ultimate baseline for risk-free investing, the short-term U.S. Treasury bond. When faced with locking up cash in a 3-month treasury at a 3.8% annual yield, Buffett looked at Google's high returns on capital and bulletproof balance sheet and decided the search giant simply offered a superior, safer return for his money. Buffett identified a company compounding capital so efficiently, it offered a safer home for billions than government bonds.